Tesla is expecting a pretty big move after they report earnings tomorrow, and the stock is already down about 67% since their November 2022 highs. We're going to talk about it right now on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, sponsored by OptionPlay. It is a pretty good day for the markets overall, but not so much for Tesla. And Tesla is now the worst performing stock of the formerly known Magnificent Seven. I don't know that we would have called it Magnificent Seven, actually, given the performance that we've seen in Tesla recently. If you go back to November, I think when I was looking at this earlier, the relative outperformance of the best performing of the Mag 7 stock, which was NVIDIA, relative to Tesla, was outperformance of about 220%. And that was because NVIDIA was up obviously very sharply and Tesla was down considerably as well. So what is fueling this decline? Why is the stock down? And we'll see what it is now. I think it was about $5 when I last looked at it. So it's down about 3.5% today. So that represents a new 52-week low. So what is going on here and how should one play it? Okay, so first of all, and by the way, if anybody has any comments or questions about other stocks that are going to be reporting, or maybe more questions about Tesla, please be sure to put them into the comment section or into the live chat, and I'm going to try to address those after we talk a little bit about Tesla. But I just thought that of all of the names that are reporting this week, this is the one that struck me as most interesting. So in the United States, if you are sort of familiar with the car business, you will know that as far as EVs are concerned so far, Tesla has certainly won the battle. They are the only one of the US automakers that has demonstrated that they can profitably sell electric vehicles. That's the first thing. They are favored over all others by a wide margin. I think that spread is not going to narrow significantly. And one of the reasons I say this is that a big part of owning an electric vehicle is, of course, charging it. Tesla has the supercharger network. Now, nobody else does except, I guess, for Ford, because they now have an agreement to work with Tesla, and so Ford electric vehicles are going to be able to use the superchargers. But this is an important aspect in making electric vehicle ownership tenable for most folks. So with all of that said, they have some other benefits as well as a company. So obviously they have a visionary running the company. That's critical. They've demonstrated that they can build some extraordinary cars. I think that is also critical. Their business model is also significantly different from the legacy automakers in that they sell directly to consumers rather than through a dealer network. And the reason that's important, and we've seen this a lot recently, is because what it means is that the company can respond in real time to changes in the demand for their products by adjusting their prices essentially instantaneously. You don't negotiate on prices for Teslas. They just set the price. That's it. You order it online. And this gives them tremendous flexibility. Now, I have seen people post and actually send me questions and said, well, don't you think this is a knock on Tesla's business model that they do this? Because people who buy the cars would be aggrieved if they paid $60,000, let's say, for a Tesla Model Y long range, and the price suddenly gets cut to 55 and then to 52 or to 50 or below. So I have two things to say about that. The first is that obviously people who paid a higher price are going to be disappointed that they didn't get the new lower price. But this actually happens even within the dealer model. And you see that because the legacy automakers will do things like introduce rebates or other kinds of cost-cutting initiatives. The dealers also have to respond dynamically to supply and demand, and they do so by offering dealer discounts. So the world of incentives, while more convoluted, still serves the same purpose in the legacy model. Tesla's just better at it, and it's more transparent. And I can also speak from experience because we had a Tesla, which we replaced. Actually, we had two Teslas at the tail end of last year. We bought a Model Y long range, and indeed the price has declined. Do I wish we'd gotten the lower price? Sure. I think the only influence I can say is that had I known that the price was going to decline as much as they have, that a separate car we had purchased, maybe that also would have been a Tesla at these new lower prices. But I certainly don't begrudge the company the ability to lower prices. And I also want to add one other thing, which is that it is a healthy thing economically. Everybody should welcome businesses being able to do this and actually doing it, because if you see prices coming down, that obviously helps combat inflation. So we would like to see prices decline. When companies are able to produce goods at lower prices, we hope consumers will benefit. Maybe we are lucky to benefit enough ourselves because we time it just right, but even if we don't, this is a real benefit. The thing is, though, that benefit doesn't necessarily translate to the company itself, because while they can lower prices to encourage the purchase of more cars, it's going to come at the cost of their margins. And if we take a look, that's kind of what's going on here. So I think we'll take a quick peek now at, so this is the adjusted EPS that you see here in blue for Tesla. The price here is in white. And what we can see with that is that's really a function of margins, right? So margins in blue, adjusted EPS in blue. We can see that these two track lockstep. Now, the other thing I think that is interesting is the vehicles sold. So lately, we have seen some declines in vehicle sales. Now, this had originally been attributed to the fact that the company was rolling out updates to their two biggest best-selling models, which are the Model 3, and also least expensive models, the Model 3 and the Model Y. But really, what we should be focused on is not so much what the sales are looking like here, which is our natural inclination. We pay attention to the things we see every day. But the real global opportunity for Tesla and the global opportunity for electric vehicles and what is going on there. And the biggest market for electric vehicles in the world today is China. And in China, Tesla has a real fight on its hands. So where Ford and General Motors, the Japanese automakers, the European automakers probably dismissed Tesla initially when they were just coming on the scene. After all, starting a car company from scratch is not an undertaking to be taken lightly. And I think a lot of people dismiss the ability of Elon to pull it off. Elon also dismissed BYD's ability to pull it off. So BYD is a battery maker in China, in Shenzhen, that was founded in the mid-1990s. And a little over a decade ago, they decided to get into the car business. And initially, they were building internal combustion engine cars. They were not that good. They were powered by engines from Mitsubishi. Then they started producing electric vehicles. Those cars have gotten steadily better and better. And the most important thing to think about here is that when it comes to an electric vehicle, the most expensive component, single large component, are batteries. And they're a battery company. And they're building some good ones. And now we have a situation on our hands where BYD, which I believe was an acronym that stands for Beyond Your Dreams or something like that. Now, we don't see BYD cars roaming the streets of the United States just yet. But over the course of the last 1.8 million vehicles produced by Tesla, BYD has produced 3 million. And they are rolling cars out that are in the low double-digit thousands. So we're talking about 11,500 and so on. So many of you may have recently seen that there were some news reports out that some people internally at Tesla were reporting that Tesla was discontinuing their efforts to produce a lower-priced entry-level car. That was going to be targeted around the $25,000 mark. Elon came out and dismissed those rumors. Regardless of whether they are ultimately going to produce that car or not, I think we do need to acknowledge a couple of things. And that is that, first of all, the biggest market and the most profitable market for the U.S. automakers has traditionally been light-duty trucks. Ford with its F-150, that was the best-selling vehicle sold in the United States for quite some time. Tesla has finally started to produce trucks, the Cybertruck, but they have run into a number of production challenges. Now all of those cars have been recalled, so that is creating its own problems because that is going to drag on those margins. They have other production challenges, not an easy car to produce. It is not entirely clear either that other than the initial enthusiasm for it, that this is a vehicle that would actually replace the F-150. And it should be said that Ford's own F-150 Lightning has proved problematic, that a lot of people who bought that have found that once they've dealt with an electric vehicle, it hasn't really suited their needs that well. So what this has caused is a very sharp decline in Tesla's price. So I'm going to go back now all the way to November of 22. I think that was actually the all-time high. I'm going to go back a little bit farther because I think that will better illustrate this. So here we are. This thing is now down, let's see, as of at today's closing price, thereabouts 142-ish. Yeah, so this thing has lost half of its value since then. And right now, the options market is implying that it could move another 10% one way or the other by the end of this week. As a reminder, and we'll just pull this up on the OptionPlay app very quickly, that if you are trying to establish what the implied move is, there's a mathy way to do it, but when earnings are close, as they are now, a simple way to take a look at what the implied move is, just take a look at the value of the straddle that expires at the end of this week. So I'm just going to take the at-the-money put and call. Stock closed around 142, so we're just going to put those two together. And what we get is about 1365. Round numbers, we're going to call it 10%. Now, there's something else to think about, too, which is that we're probably going to get a pretty big vol crush in the options that expire in the coming weeks to couple of months. But I also believe that the longer dated premiums are probably going to hold in there pretty well because the dynamics I've just described are going to be playing out for some period of time now. So one way that one could try to play this is by selling this near dated elevated premium. And what I'm going to do now is I'm actually just going to take the options that I loaded in here that expire this week. And I'm just going to say, all right, well, if the stock is going to move, call it 13, 14 bucks from 142, that gets us down to 129-ish. Here, we'll go 128. So we'll take $14 on each side. That's going to be up to about 156 or so. I'll use 155 on the short side. So selling the calls and puts, that's a strangle, by the way. When you have a call and a put of the same expiration, we call that a strangle. Selling the nearer dated strangle, and then looking to purchase a longer dated one that is going to go out far enough in time that it's going to capture a number of other events. And right now, so we don't know specifically when the next earnings are going to be, but we can kind of guesstimate when that's going to be. At least one source is estimating that that's going to be on July 19th. July 19th is dubious to me as a likely date. And the reason for that is I happen to know because it happens to also be an expiration day, regular expiration day. If it is an expiration day, then it's going to be a Friday. So it's unlikely that the company is going to be reporting earnings after the close on a Friday. Companies don't typically do that. So I'm going to guess that that estimated earnings date is incorrect. And I'm going to go out a little bit further and choose the August options instead. And then you're going to try to buy, basically, you're buying a put calendar, you're buying a call calendar. That's one way to think about it. And so I'm going to try to choose strikes that are relatively close to the ones for the nearer dated options that I'm selling. So you can choose the 155s and so on, and you end up with this structure right here. And people who have watched these live streams before know that this is a trading strategy that I tend to favor when I think that the stock is not going to move largely beyond the implied move. So the upside break even in this case, the estimated number is about 168. On the downside, it's about 125. 125 actually is a little bit tight because I kind of feel like if it's going to move, we want to give ourselves at least a little bit of a buffer to that downside. Let's just take that down a little bit. We get that now. Downside of about 120. This thing can move. I mean, we shouldn't kid ourselves. 10% sounds like a lot for stock to move within a week, and if this was Procter & Gamble, it would be. But the fact is that when you're dealing with Tesla, I mean, heck, the stock moved down 12% just the day that they reported earnings last quarter. And so now we're short a day and then another 3 or so into the week, end of the week. So just taking a look at this, see what kinds of moves we have seen. So actually the average move is a little bit less than I would have expected over the long term. So the average move is indeed about 10%. So okay, maybe that's reasonable. But as we can see here, several of the most recent earnings moves have actually been much sharper. So when they reported their Q3 23 earnings, stock dropped almost 17% from the day prior to 3 days following. So over a comparable period of time. So we could see some big moves, but I think this is probably a pretty reasonable. I mean, let's take a look at that. So 120. I mean, that's a decline of 15%. That's your downside break even, and the upside break even. It's not going to be quite as So 168 over 142, so 18% to the upside. Bearing in mind that doesn't account for all of the vol stock. The August options are not going to get crushed the way that any intervening expiration that does not have other events baked into it, those are going to see probably a bigger vol crush. But I think this is, an important thing. Okay, so so actually, if you're looking at the chat. I think we now have a way for me to share this trade in OptionPlay. In the chat. So I'm going to try to do that now. So I hit the trade button. If I hit the trade button, let's see. And let's see, did that share? View this Tesla trade. I think that actually worked. Okay, so for those of you who are watching this, you're going to see that I have shared this trade. There's a little bit of a lag timing-wise, so please bear that in mind. And actually, I think this is also going to be helpful. So again, for those of you who have the OptionPlay app, you can click on that link and it's going to bring the trade that I was just working on up. So you'll find that in the live chat. If you do not have the OptionPlay app, there is an affiliate link. You can actually sign up for a free trial, and you'll be able to see it there. So you know what I'm going to do is just once again, I'm going to just post that link into the chat as well. And so you just go to, if you want to see any trades that I share here and interact with them dynamically using the application the same way that I'm doing it, what you can do is sign up for a free trial if you aren't already a user. Okay, so let me go through some questions here and see. Let's see what we got here. So Corey Henderson asks, I was trying to wait for Tesla to have a report, maybe 2 reports. At what level is it a screaming buy? 100, less than 100? A screaming buy. Well, that's a tough one. It's a screaming, we only know it's a screaming buy with the benefit of hindsight. But actually, let's give some thought to this. So what's interesting about Tesla is that for a long time, people have struggled to say what they thought the company was. Is it a car company? Is it a technology company, an AI company, a self-driving technology business? If you strip it into these things, and I think there's a little bit of all of these things in it, I would not value Tesla the way I would value other car companies. I think the legacy automakers are in real trouble. Let's just compare 2 companies. What the heck? Let's start with Ford. All right. So Ford Motor Company right now trading $12.88 a share. Company is valued at about $51 billion. That's the market capitalization. The enterprise value is even lower because, at least according to these financials, they're carrying some net cash. And the company is forecast to do $1.87 in full year EPS. And that puts it, quite incredibly, at less than 7 times earnings. Now, if you're looking at the enterprise value, enterprise value is a way to think about a business once you have stripped out the net debt or net cash. So just taking a look at the total value of the enterprise. Here's a quick point, too, because I've said this before. You can't really look at financial companies this way, but this is an important concept. When you're looking at market capitalization, you are looking at the equity value, and you wouldn't normally do that for most assets. You wouldn't do that for a house. You don't look at a house and say, oh, well, the owner of that house has $250,000 worth of equity. What you want to know is the value of the house itself. So you're not going to include the furniture that's inside or the cash that the guy has in his wallet and his bureau, and you're not going to count the value of his mortgage. You're going to count the value of the property. And when we think about businesses like this, sometimes enterprise value is a better way to think about it for that reason, because you're basically saying, I'm going to not think about how much the company owes in debt. I'm not going to think about how much cash they have. I'm just going to think about the value of the business. Now, that's not to say that when you're buying a business that those things don't matter, because those things specifically speak to how much capital is available or cash is available for them to handle their ongoing operations. But when you're thinking about valuation, it's really sort of that X cash, X debt thing that you want to think about. This was one of the reasons why several years ago, Apple's valuation was so confounding, because the value of every share, the company had so much cash at that time that about 40 cents for every dollar you spent on a share of Apple stock was basically just the cash they already had on their balance sheet. So you really want to sort of understand the value of the business as well. So another sort of way we can think about this, $43 billion enterprise value, and the company is going to do about $5.5 billion worth of free cash flow. So that's 7.8 times. Another way to think about that is that's a 12.8% free cash flow yield. And you look at that and you think, this company is impossibly cheap. How could that be? Well, I can tell you how that can be. They are like many other businesses, going to be dealing with competition, of course, competition from BYD. So BYD is not just Tesla's problem, it's every automaker's problem. If they're going to start selling cars in Europe and Asia and the United States, and they can produce cars for less, particularly EVs, which American automakers and many European automakers have really struggled to build profitably. They also make plug-in hybrids, by the way. That's a real threat. The US automakers, excluding Tesla, also have just negotiated new union contracts. Now, this is not, I'm not making an opinion here about whether or not the automakers should have unions, but the fact is that they are going to be paying significantly higher labor costs. So higher labor costs, we know we're transitioning to EVs where they have struggled to be profitable. Both of those things are significant problems. What other problems do the automakers have? Well, one of the big ones, of course, is the fact that we have much higher interest rates. If interest rates are higher, then that means that purchasing a vehicle for consumers is more expensive. So that is a problem. We have higher gas prices. If Ford makes most of its money selling F-150s and nobody wants the Lightning, and gas prices are higher, that's a problem. So you start stacking all of these things up and it becomes a problem. And then you recognize that Ford doesn't make some of the, basically where we're pivoting to, the EV space, they don't make cars as profitably as Tesla does. That creates a problem. And then Boyd is yet another, I say Boyd, it's not really Boyd, BYD. That's going to be confusing too, because BYD actually is the ticker symbol for a company that's called Boyd. It's a Canadian auto repair company, by the way. So they are also in the auto business. But we're not going to talk about auto body roll-ups. But that is an issue. So the question was screaming buy. Well, if Ford's not a screaming, if it's not a screaming buy at 8 times, where would Tesla be a screaming buy? Because it's not trading anywhere near those levels. Tesla is probably going to do about 276 a year, full year EPS. Okay, so where does that get us? That means it's trading at about 51 times full year earnings. If, big if here, if they were able to generate the 367 a share that the street is currently estimating, and we're going to get a much better visibility on that after they report, that's 38 times next year's numbers. Is it a screaming buy there? Well, if what we hear on the call suggests that that 367 a share is achievable, that is going to represent, if that math is right, about 32% year-on-year EPS growth. By the way, notice something here too, which is that the street is expecting them to do about $6.6 billion in free cash flow full year 2025, which I believe is higher than what Ford is going to be able to achieve over that same period. I'm sure some of you have heard of something called a PEG ratio. PEG ratio is the price to growth. If you have a price to growth of 1 or lower, that is generally a good thing. That suggests that that you're paying a reasonable amount. So this is what we often talk about. You can buy great companies, and sometimes you can buy companies at cheap prices. You can rarely get great companies at cheap prices. So what we hope to get is at least a fair price, getting great companies. So focus on buying a great company, and then hope you can get it at a reasonable price. What is a reasonable price? Also, sometimes people refer to that as GARP, growth at a reasonable price. If you could get this thing at 32 times that number, I would say that is a very reasonable price. So 32 times 367 gets you to $117 a share. So what represents a reasonable price? Screaming value? Don't know about screaming value, but a reasonable price, to my eye, for Tesla right here is about $117 a share. That's assuming that the news we get out of the company tomorrow indicates that that 367 is achievable. If you're looking for levels to potentially write puts, 117. Now, bear in mind, take a look at the trade we just did. What were we doing? We were, selling puts a little higher than that. But that was kind of the thinking. Now, it is not common in most instances for you to be able to just say, okay, I'm going to sell puts at prices where I think a stock is reasonably priced and sell calls where I think it might be overpriced, unless the options premiums are really quite high, the way they are in Tesla. And the reason you're not going to be able to do that is because this difference in those strikes relative to the current stock price is going to be very small. You know, you can't say, oh, well, I hate the stock at the current price, but at a 5% discount, what a bargain it'll be. If you're talking about a bond, maybe something like that would be true. But if you're talking about a stock, it's going to be a whole lot more challenging. Okay, so let's see if we can find some other questions. So I don't know if I don't know if I answered that question, but what I'm saying is that when we listen to the earnings call for Tesla tomorrow, if we still believe that 367 is achievable for full year 2025 EPS, then I think the company would represent a very good purchase at $117 a share, and probably slightly better than that, because I would say that this is a company that has traditionally skewed optimistic when you think about its multiple. So, yeah, that's we'll look to that. Okay, so for returning viewers, is the white background easier to read, harder than the dark? No difference. Oh, that must be from our producer Jay. So that's an important question. So, yeah, I mean, we're just trying to make this more visible. So, please, lend your thoughts and your suggestions to that. Okay, here's a general question. Ranjana Gupta asks, how do you choose strikes for a poor man's covered call? This is a good question. Let's break it down into parts. I think that's important. With respect to covered calls. So we don't need to think about the long side first, but when you're selling covered calls, what are the things I like to think about? The first is that I expect my covered call to generate yield that is at least commensurate with taking equity market risk. Because a covered call, this is what you're doing. You're buying the stock, you're selling a covered call. Because you own the stock, you have equity-like risk. Selling a cash covered put, very similar situation. You're taking equity-like risk. Equity-like risk, there's two things about this. Number one, the average return for equities on over the course of the last, since 1990 or so, is probably north of 12% a year. So I'm expecting to get some measure of return that's roughly commensurate with that. So that's about 1% per month. Now this is going to vary. Some stocks are highly volatile, and therefore you expect to get a higher return. Tesla, that we've just spent a lot of time talking about, is a good example of this. Others are not going to generate those kinds of premiums. Kroger's, Albertsons, those two are grocers that I've been talking about merging, and that's going back and forth. But these are not highly volatile stocks. Procter & Gamble is not a highly volatile stock. Coke and Pepsi, Kimberly-Clark, these are not highly volatile stocks. Hershey's, was not traditionally a highly volatile stock, although over the course of the last couple of years or so it has been. On the other hand, if you're dealing with NVIDIA, you're dealing with Tesla, your demands for returns are going to be considerably higher. What else does it make sense to try to look at when you are establishing whether or not the yield you're collecting for selling premium is sufficient? Well, there's a mathy way. The mathy way involves understanding that volatility for the value of the enterprise, I was talking about that before, affects both the value of the bonds and the value of the equity. And you can try to do that math. Robert Merton did a lot of work on this. Actually, my colleague Mark Guthner, who we've had on some of these live streams, he wrote a whole book about that topic, Quantitative Analytics and Debt Valuation and Management, which was published by McGraw-Hill. But there's a simple way to do it as well. I actually have an example. Because I happened to be looking at this earlier today for reasons unknown. Las Vegas Sands, this is a stock that's really been beaten up lately. Particularly just over the course of the last couple of weeks or so. I think we have a chart of it here. I'm going to punch it into OptionPlay as well, so we can look at that. Maybe I'm going to put it into OptionPlay. What am I doing here? It's all right. Okay, so somebody was looking at selling some covered calls in Las Vegas Sands. It's one of the analysts that covers the gaming stocks that I work with at the family office. So he was looking at selling, if I remember, I'm actually just going to put in exactly what he was looking at. So owns the stock. He has a lot more other positions than that going on. But I believe he was looking at selling the June 52.5 calls against that stock position. Okay. And the reason he was looking out to the June 52.5s, or maybe actually even been the Julys now that I think about it. I think it was the Julys, the 52.5s. So why don't you sell the July 52.5s? We were trying to handicap when we actually think the earnings are going to take place. And this is another one of those situations where it was not entirely clear whether they were going to report earnings that were going to be captured by July or whether it was going to fall just outside of that. And my suspicion is that July is not actually going to capture that earnings, but there's a little bit of a bid to the vol premium there. So that was the reason I was looking at that. Okay. So those options expire in 88 days. And let's just take a look at a little bit of the math here. You can sell right now, mid-market, those calls are about 77 cents. Stock is 46.56, so that's going to yield about, on a standstill basis, about 1.65% of the current stock price. That's one way to think about it. I also like to compare it to the strike sometimes. I think that's more important when you're selling the put because think about it this way. If you sell a cash-covered put, the yield that you're collecting is on the risk that you are put the stock at the strike. So the lower the strike, all else equal, the better off you are. So you're kind of looking at the premium relative to the strike. Be that as it may, 1.65% over 88 days. Well, how good is that? We can annualize that, and what we end up with is about 6.86%. Okay. So how do we feel about taking an equity-like risk for 6.86%? Well, Las Vegas Sands has debt. They have a couple bonds outstanding. And if we take a look at their bonds, if I just take a look at the bonds, they actually have some short-dated paper that, as it happens, matures in August. And as it turns out, those bonds have a yield to maturity of, and there's a lot to look at here, I realize that, but I'm pointing to it up here in the upper left. The yield on those bonds annualized is about 6.32%. If I go out to the next year, I think it's they have some that are also maturing in August of 2025. It's about 6.8%. So what I'm seeing is that the standstill yield of selling calls about that far out is about the same as what I would be getting for buying the 1 and 2 year paper. The credit, I'm talking about the bonds now. So is that reasonable? Yeah, I think it's okay. I would not be interested, though, in collecting any less than that. So now we're talking about the covered call. So just to go over these things a little bit so we know what we're talking about. If you are selling calls against stock, you want to get a yield that is at least appropriate for taking equity-like risk. The yield will go down as you choose strikes that are further out of the money. So in the example that I'm giving here, selling a July 52.5 call, which expires 88 days away, that is longer than I like because options decay more rapidly as expiration approaches. So this is maybe not the best example of a covered call, but I'm just trying to give you a sense of how you want to think about this. You want to get a yield, an annualized yield that justifies doing it at all in the first place. So I think this is a very borderline case. I'm getting 6.8% annualized, but I'm selling a 52.5 strike against a $46.5 stock. So I still have, 12.9% capital appreciation potential in this case. And then I'm getting, give or take about 1.6, 1.7%. Okay, so we want to keep the call that you're selling inside of 90 days, 45 days might be a little bit better. Some people like to sell really short dated paper, 1 month out, sometimes even weeklies, because you can collect more theta. That's the sort of decay that you're collecting. But that requires a lot of active management. So if you're more of an investor and you're doing this as an investment strategy rather than a trading strategy, you probably want to target, we'll call it 30, 45, 60 days to expiration. And you want to get something north in terms of premium of what the bonds, if the company issues them, is otherwise going to pay you. Another important reason that looking at the bonds, by the way, can really be helpful in a context like this is if you look at the bonds and they're yielding 20, 30, 40%, what does that tell you? A bond that's yielding 40% to maturity, there's a very high probability that the company's going to default. Well, if the company's going to default on the bonds, what's that going to mean for the equity? Your first loss, right? So you buy the stock, you are the first loss if the enterprise goes under or files. You need to earn some pretty substantial rates of return if you're going to sell premium against that. Okay, so that gives us a sense of what calls you're going to sell. So generally don't speculative grades, companies that are at a high risk of default. Buying the stock and selling calls, being short the puts effectively on the equity is not a great do, probably. That's a pretty risky situation to be in. Okay, so now we know what you're selling. What are you going to buy? So for me, there's a couple of things to think about on the poor man's covered call. So poor man's covered call, rather than buying stock and selling calls against it, you are buying calls and selling calls against it, longer dated calls. Well, we often talk about how there's a vol crush, the implied volatility, the extrinsic value of the options, the premium starts to get sucked out whenever there's an event. So you have to keep your eye on the event's calendar. And if you know that there's an event coming up and the options you're purchasing captures only one of those, and you know that implied volatility is going to drop as soon as that event takes place, that's probably not the call you want to buy. So you need to go out far enough in time that you won't be caught out by that ensuing vol crush. So again, looking to Las Vegas Sands as our example in this case, and actually if you want, feel free. Just mention whatever stock it is, you or anybody. Please, if you have questions about stocks, tell me what stocks, we'll look at them. You need to go out at least far enough in time that you are not going to get caught by, buying an option that captures earnings and then earnings comes out and then all of a sudden it gets sucked out. So Las Vegas Sands reported last week, so that's out of the picture. The next earnings are July 19th, supposedly, but I actually estimate that it's probably going to be the following week. And why do I say that? Because I was just going, companies don't typically report after the close on Fridays. So the company's going to have two choices. They can either, if they typically report on a Thursday or a Wednesday, you can go back and calculate when they normally report and then say, all right, well, are they more likely to report before this estimated date, which is going to be maybe the 17th on a Wednesday after the close or Thursday, or are they more likely to push it to the subsequent week? So I look at the calendar and what I can see here is that they report, I see a July 21st report date, I see a July 20th report date, I've got July 22nd, a July 24th. You see the pattern that's emerging here? That more often than not, when they're reporting in late July, it's going to be in the 20s, so it's probably going to be the subsequent week. So they're probably going to push it out rather than advance it forward. What that means is that if I'm going to own an expiration that I think is going to capture that event, it's probably going to need to be August at least. The next report is going to be in October, so I'm probably going to go out a couple expirations in terms of what I'm going to own. The other thing is that, I want that longer dated options going to be at, or maybe even slightly in the money in some cases, but at the very least, it's going to be at or below the strike of the covered call I'm going to sell. So where has this gotten us to when I put all of this stuff that I've been talking about for so long together? The call that, if you're going to use a poor man's covered call, which is buying a long dated call and selling nearer dated calls against it, make sure you're not going to get nailed by a vol crush. So that means you have to go far enough out in time that if there's any immediate catalyst that you can see on the horizon, that you're going to go out much farther than that. So if there's an earnings, try to capture 2 of them, right? Choose a strike that is at or below the strike of the call that you're selling. If the call that you're selling, 45 days to expiration, maybe that's, a starting point. Also want to pay attention to the events calendar, but don't make that too far out in time because you're just not going to get that decay. Okay, so I hope that helps on that. Let's see here. Okay, so where were we? We asked about the white. We did the poor man's covered call. All right. Mike, can we access your trade in OptionPlay after this session? Yeah, so the link, okay, so the answer is yes. When I provide a link to a trade, that is going to stay valid for as long as the trade is valid. Now, if you come back and you take a look at this trade in a couple months' time, the Tesla trade, for example, where we're doing the call calendar and the put calendar, sometimes we call that a strangle swap. Doesn't really matter what you call it. We're buying longer dated calls and puts, and we're selling near dated ones against it. If you follow that link, though, after the near dated options have expired, it won't be. It'll still capture, I believe, the longer dated options that are in it, but it will not reflect options that have subsequently expired. So the link remains valid, but parts of it may not be. What's interesting about that, though, is that if you're going to play with that link in the application and you have that longer dated one, you can then use it to identify, okay, well, what strangle do I sell now? Or what options can I sell now against the longer dated premium? So you can interact with the strategy dynamically even as parts of it roll off. So I think that's important, and I hope that's helpful. Okay. Here's one on a discretionary name. What do you do with a call calendar which spans 2 earnings? Bought when the stock was higher. Stock drops 10%. I had DRI, that's the Darden October, June 165 call calendar when Darden was about 165. Substitute 160. Okay, well, let's take a peek at DRI, and let's see if I can actually construct the trade properly. October, June 165. June 165 call calendar. Okay, so this is interesting. To begin with, the longer dated call doing exactly what I was just talking about, right? Which is going out far enough in time. I think that's a common mistake, by the way. If you're trying to buy longer dated premium, long dated doesn't mean, 4 or 5 weeks away. So this trader here, PC is his acronym, bought the OCT 165s back when the stock was trading 165, which actually not that long ago. So the stock was right around that in early part of this month, round numbers, let's call it. So owns, I should say, the October 165s and is short the June 165s now. So, oops, I put puts. We should have calls here. So here's that trade. So just a quick point about this. If you put a trade like this on when the stock is trading around 165, what you're really looking to have happen is you want the stock to finish at that 165 level at expiration. And it has now drifted away from that. Now, I don't know what prices you initiated the trade at, but obviously this is not the sweet spot. Now, if your expectation is that the stock is going to drift up to that 165 level, and you're still playing for that, you don't necessarily want to get caught chasing. I mean, the average analyst price target, not that analysts are so great at forecasting where stocks are going to go, but just for perspective, the average analyst price target's about 178 for this thing. So if your expectation is that the stock is going to drift higher, then the one you have on is probably fine. That's the first thing I would say. But I will also say that the probability of profit, because you need the stock to go higher, is not going to be as high, at least theoretically, as it would be if you indeed lowered the strike, which is what you are proposing here. So we can see that if we just drop these strikes down to 160, you can see in this picture, this diagram, that basically we've just migrated this shape such that we're now kind of going to be in the money if time just goes ahead and passes. I would suggest that what you're thinking about here is probably the right way to think about it. That the probability of profit, because it's out of the money, has gone down, and you're not lowering the strike all the way down to the current stock price, because that's a good way to get whipsawed. You put the trade on, something comes out of left field, not quite what you hoped for or expected. Stock sort of migrates away from the sweet spot for the calendar that you're in. So now you think, oh, okay, well, I'm just going to readjust it to the current stock price. And then the stock recovers and you're caught chasing again. Minor adjustments, if you're going to make them, is probably a better way to go, unless you have a really clear sense, because of new information that has arrived for you to digest, that the previous price target is completely unfounded. And actually, let's take a look at let me see what's happening here in Darden. Let's take a look at it. First of all, let's take a look at it technically. And I'm not a technical analyst, by the way, but that doesn't mean I'm not very interested in what's happening with the technicals. So first of all, you can see just on the app itself, it's going to show, and actually we just pulled up the Bloomberg terminal on that screen, but actually if you're just on the OptionPlay app itself, we'll just go to that first. It will provide the first two support and first two resistance levels down here. Now when I expand this, you're not going to see that, but the initial level of support here is about 149.20, which is 5% lower than the stock's currently trading. 141 is the next stop to the downside, and we don't have resistance up until 167.5. We do have this unfilled gap up here, which I think is kind of interesting. The other thing I would say is that this is not an immensely expensive stock. They've been growing the top line very nicely. EPS not really forecast to grow at quite the pace that it had historically. But still looking at, call it 10% EPS growth is essentially what's forecast. That's a pretty good slowdown from where their growth had been over the course of the last couple of years. Not surprising. Look, consumer discretionary spending ramped quickly as we came out of the pandemic. A lot of people wanted to get out there, go back to restaurants. Darden is kind of in that in that demographic that in particular really made an effort to get back out there. 883, let's just use that. 883 as a full year EPS estimate. That gets us to 17.5 times full year, growing the bottom. It's probably going to have high single digit year-on-year EPS growth thereafter. That is a below market multiple with above market growth. So, I think that, from a fundamental standpoint, I think it's quite reasonable. The issue we have for this and everything else, it actually kind of goes to what I was talking about with Ford earlier. We have these higher rates. Inflation has remained a real ticklish sticking point for consumers. I recognize that everybody is, a lot of people who are pulled up on the economy have been talking about the fact that, we've got strong GDP growth, we've got very low unemployment, and you would think that low unemployment and strong GDP growth would, essentially bode well for consumer discretionary spending. The problem is, and there's a couple of them, one of the problems is inflation, and the other problem is that economic growth, in my view at least, is a bit deceptive. We have 7% of GDP plus in federal budget deficits. If you pull that out of that GDP number, things don't look anywhere near as good. In fact, if you say, okay, well, we've got GDP growth that's in the neighborhood, and let's see what the most recent print was, just as a reminder for everybody. So the most recent GDP numbers, and we'll be getting some, so what do we got here? To go back in time a little bit. So I apologize, I just didn't commit this to memory. I should probably have it right off the top of my head. But where are we? So we've got annualized, taking a look at the most recently reported quarter. So this was reported back on the 28th, and the number came in better than the survey was. The survey was for 3.2% annualized growth, and the actual number came in at 3.4. Okay, 3.4% GDP growth. Sounds pretty good. But if you also have inflation tracking at, around the same numbers, so mid threes. I mean, we'll just keep the math easy, and just as a way to think about the problem. If you have 3.5% GDP growth and you have 3.5% inflation, how fast is your economy growing? It's not, right? So it's adjusting for inflation, it's not growing. Now I tell you that more than 7% of GDP is federal budget deficit spending. How healthy is this economy now? Not very is the answer. So you add this into a fairly toxic cocktail of inflation and rising consumer debt levels, and it's a really difficult situation. You have I think consumers, not terrific. So it's trading at a discount for a reason with Darden. Now the thing is, I'm just going to say this. I go to restaurants. It seems like people are still getting out there, but I don't think it should trade at a premium to the market for that reason. I think that the growth rates we've seen are going to slow. I'm just going to punch through. I'd love to answer more of these things, and I apologize for not taking so long on each one. If Meta has good earnings results, do you think that will create momentum for the rest of the Mag 7 and change the market dynamics in the short term? No, I do not, and that is because I think Meta is kind of its own thing. Of course, it's a positive for the market overall because Meta is a big constituent for the index. But the fact is, we're talking about two very different constituents in the Mag 7, and that is that, good news for Meta doesn't translate to Tesla. Tesla has to contend with BYD, as an example. NVIDIA has to contend with a very rich valuation. Meta doesn't necessarily, because their valuation is actually not that crazy, generating huge free cash flow. And it seems like Mark and the gang have kind of gotten off of their, we'll spend any amount of our free cash and any amount of our earnings on the metaverse. Now they seem to be finding a pretty good balance. So, I liked the company when it was lower, still like it, until it really starts to beat me up. And that means the stock has to roll over significantly before I've decided I'm not going to really care for it that much. Don't know if you're following any Canadian stocks or not. If you are, any stars for a poor man's covered call in the financial sectors. It's funny, we were just talking about Boyd. So Boyd, BYD, that's a Canadian company now. and it's actually called Boyd Group Services. Boyd Group Services is this collision repair thing that I was just talking about. It's basically a collision roll-up. And, that's kind of an interesting business. We have seen, this is a topic I actually really wanted to address. Insurance costs have been shooting through the roof. Insurance costs have been rising in part because things like auto repair costs have been going up. Part of that is because you have cars like Tesla in the mix, a little bit of a problem there. But this company is going to do what, $7? This is now, that's actually being reflected in US dollars, but we call it $7. That's a potential growth story. I would sell covered calls against it just because I think the valuation's getting a little testy for me. But, this is not the kind of business people usually get excited about. But if you've actually banged up your car recently, you had to go to an auto body repair shop and you see what these guys are charging, trust me, it's an interesting area. We actually replaced the left front fender of our 2024 Tesla, and ended up doing that ourselves, believe it or not, because the repair bill was going to be $6,000, and I was able to do it for $400. But anyway, that was kind of interesting. What do we got here? Okay. This is a real, GTN. Okay, so Gray Television, you must have picked this thing up by screening. GTN, Gray Television. Gray Television is not the kind of company that's going to appear on most people's radar. It did appear on mine, though, a while ago, and the reason it did was because this thing was just trading very, very cheap. And, and here you can see that. So I think the street is expecting $3.81 a share in earnings, and the stock's $5.87 a share. So you don't find too many stocks out there that are trading for less than 2 times full year estimated earnings. Why is that, though? And the reason is that the media business is just turning over so fast, it's changing so quickly, that there's a question about whether this company can actually sustain its business. And if you're looking at this, let me see if I can find a way to, can I blow this up somehow so you guys can see this a little better? I think I can do that here. Remember what I was talking about earlier, enterprise value. This company's got a lot of debt. So what we're looking at here is, the company's $590 million market capitalization, but it's got $6.2 billion in debt. So the enterprise value of the business is $7.5 billion. The market capitalization, if you think about it this way, the volatility of the value of that business, if you think the value of the business could change 10% this way or that by the end of the year, that's a $750 million swing in the value of the business. And that is more than the entire market capitalization of the company. So it's great that they're looking to pay off some debt. It's great that some insiders are buying the stock. This is a really volatile situation, though. So just know that going into it. So let's see what else we got here. I mean, I'm sure there's plenty of questions, and I would love to add them all, but I've already chewed up an hour of your time. And I could go all night, but you guys probably can't. So for sticking with me as long as you have, I really appreciate it. Like, subscribe, all that good stuff. Throw your comments and questions in here. We're going to try to make this better and better if we can. And bring questions about specific stocks. So we'll try to work through them together and see what we think. I really appreciate your time. Thanks for watching.